Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Nebius.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. With Nebius, when you really synthesize all the research, one story just jumps out.
And what's that?
It's an AI infrastructure company, but one that is executing one of the most aggressive capital deployment strategies I think we've ever seen.
Okay.
The growth numbers that are kind of underpinning this whole story are genuinely staggering.
That's the core tension here, isn't it?
Yeah.
Nebius is basically selling the pickaxes and shovels for this AI gold rush.
Exactly. They're focusing on the compute capacity itself.
So when we say staggering growth, we need to put that in context. How do the historical numbers really set the stage for what's coming?
You're right. We have to separate what they've done from what they are contracted to do. I mean, if you just look at the recent past, the company is in undeniable hypergrowth mode. Okay.
Their Q3 2025 revenue, it was up approximately 355% year over year.
355%, that kind of number is what grabs the market's attention.
It does. And management has taken that momentum and tightened their full-year guidance for 2025 to a pretty robust $500 to $550 million range.
And they expect to hit the midpoint of that.
That's what they're saying.
A 355% jump is huge, but, you know, sophisticated investors are always looking ahead. We've seen growth stories like this hit a wall. So what's the long-term trajectory that justifies the kind of valuation they have?
And that is the central point. This is why the whole AI infrastructure land grab idea is so compelling here. The key metric is their annual recurring revenue, their ARR.
Right, the predictable contracted revenue stream.
Exactly. They're targeting $900 million to $1.1 billion in ARR by the end of 2025.
Which is already significant growth. It is. But the real, almost unbelievable jump, the step function change, is their target of $7 to $9 billion in ARR by the end of 2026.
Okay, let's pause on that for a second.
It's a huge number.
Moving from roughly $1 billion in contracted revenue this year to potentially $9 billion next year. That puts Nebius in a completely different category. That's not just organic growth.
No. That implies they are building and contracting entire global data center fleets, all at the same time.
It's a massive bet that the capacity they're building right now will be used, contracted, and earning money almost immediately.
That's precisely the bet. They are moving to capture value in a market where GPU capacity and the power to run it are they're so far behind global demand.
They're essentially saying, we build it, and they are already legally obligated to come.
That's the model.
Which, of course, demands massive investment. So the next logical question is, how on earth are they funding this? And what does it mean for the bottom line today?
Well, that's the immediate trade-off, isn't it? The heavy spending. Nebius is still loss-making, which you'd expect.
Right.
However, management has guided that adjusted EBITDA. That's basically a measure of operating profit. They expect it to turn slightly positive at the group level by the end of 2025.
On a run rate basis.
On a run rate basis.
So even if the full year is still negative, just hitting positive adjusted EBITDA for a quarter would be a huge inflection point. It shows the existing operations are starting to pull their own weight.
That's the signal the market is looking for. Exactly. Now, about that cash burn, we did see their Q3 net loss widen to nearly $120 million.
And if you're a skeptical shareholder, that number looks terrifying.
It does on its face, yeah.
So how did the street interpret that? Was it seen as a negative, or was it, a necessary evil?
It's all about the context. The crazy thing is, that widening loss was driven directly by their aggressive ramp spend and these huge capital expenditures.
It wasn't because of a failing business.
Not at all. It happened alongside that 355% revenue growth and the major contract announcements. And what's more, the company actually beat consensus expectations for both earnings per share and net revenue.
Okay, so this confirms they're intentionally running cash flow negative. It's a land grab.
It's a land grab. It's an aggressive investment to seize what they see as a generational opportunity. They're spending because they know they have customers with contracts in hand, just waiting for that capacity to go online.
That distinction is so important. Strategic spending versus, operational hemorrhaging. So if the loss is widening that much in one quarter, the capital requirement must be just astronomical.
The numbers are enormous. Nebius sharply increased their 2025 CapEx guidance.
From what to what?
They went from planning around $2 billion in CapEx to an accelerated, massive $5 billion commitment.
$5 billion. Wow.
That's the engine they need to secure the two main bottlenecks in AI power and data center capacity.
That is a staggering acceleration.
Right.
I mean, $5 billion in CapEx is not a small sum for any company.
Yeah.
What do they actually get for that $5 billion? How does that build their competitive moat?
It builds a moat defined by pure scale and scarcity. See, power is the absolute bottleneck in the AI world.
Right.
It takes years and regulatory hurdles to secure new, reliable power. Nebius is now targeting 2.5 gigawatts of contracted power by 2026.
Up from what?
Up from a prior plan of 1 gigawatt.
Just to put that in perspective, 2.5 gigawatts is enough to power a small city.
It is. And they also expect 800 megawatts to 1 gigawatt of fully connected capacity to be online by the end of 2026.
So locking up that much power is a serious competitive advantage. New players just can't get that kind of resource quickly.
They can't. And their moat isn't just the raw capacity. See, that $5 billion CapEx risk, it's significantly de-risked because all this capacity is essentially pre-sold.
Through those big hyperscaler partnerships.
Exactly. It's like building a massive apartment building that's fully leased before you even break ground. The bank is happy to finance it because the revenue is already guaranteed.
You're talking about those huge anchor contracts.
Specifically, the estimated $17 to $19 billion contract with Microsoft, which is just massive,
Yeah.
and the approximate $3 billion deal over 5 years with Meta.
These long-term, multi-billion-dollar deals are what pre-underwrite their entire future.
They do. The company is basically leveraging the credibility of Microsoft and Meta to get the financing to build capacity faster than anyone else.
And that must create huge switching costs for those customers.
Massive. Migrating large-scale AI environments is complex, it's costly, it's risky. Once they are locked into Nebius's infrastructure, they are sticky.
Which gives Nebius that high-quality, predictable forward revenue.
That's the definition of it.
And we should mention they're also moving up the value chain, right? It's not just about selling raw compute time anymore.
That's a great point. They're actively broadening their offerings. They have platforms like Aether 3.0, which is their enterprise AI cloud platform, and something called the Nebius Token Factory.
And what does that do?
It focuses on optimizing inference for open source models at scale. This is all part of a strategy to move from being just a data center operator to more of a neo-cloud provider.
A specialized AI native cloud.
Exactly. Offering higher value services, not just racks and power.
It sounds like a powerful, virtuous cycle. Pre-sold capacity funds the CapEx, which creates more capacity, which attracts more contracts. But if you're a skeptical investor, this whole thing rests on that capital intensity.
Yeah.
What are the key risks the market is grappling with?
Well, the top risks are, capital intensity and the dilution that comes with it. That $5 billion CapEx commitment leads directly to huge financing needs.
Right.
So to support it, they're using an at-the-market, or ATM, equity program for up to 25 million shares.
Okay, an ATM program. Now, for many listeners, that sounds a little scary, right? It's a controlled sale of new shares directly into the market over time.
It is, and it means dilution for existing shareholders, no question. But the method is considered more measured than a traditional big offering.
Because it's not just dumping a huge block of stock on the market all at once.
Exactly. It allows them to gradually issue shares, tap the market when the price is good, and raise capital exactly when they need it for CapEx. Management keeps saying they will be dilution sensitive.
Still, that ATM news triggered the recent volatility, didn't it? The stock dropped pretty violently, about 30% from its October highs?
It absolutely fueled that pullback.
So doesn't that suggest there are deeper worries about this dilution trade-off?
It does, but the consensus view now is that those concerns are at least partially priced in after that 30% correction. I think investors basically accepted that drop as the cost of underwriting the capacity that's going to generate billions in future ARR.
And the other major risk we flagged was concentration.
Customer concentration, absolutely. Their growth is so heavily anchored to Microsoft and Meta.
Which are great partners to have.
The best. But relying so heavily on just two giants creates exposure. If either one shifts their AI strategy or delays their ramp-up, Nebius's targets are at risk.
That's a significant vulnerability, even with multi-year contracts in place.
It is. The main mitigating factor, though, is the broader market. The AI compute market is just incredibly supply constrained.
So even if one of them pulled back?
A low probability, by the way. But if they did, that capacity could almost certainly be reallocated very quickly to another hyperscaler or AI company that is desperate for compute power. That scarcity acts as a backstop.
Let's shift to the stock performance itself, because this thing has been a massive high flyer.
It's been parabolic. Nebius delivered a return of over 500% in the last 6 months. That puts it among the absolute top performers in the tech sector.
It's currently trading just under $100.
That's right.
We talked about that 30% correction from the October highs. High beta stocks like this are just prone to those violent pullbacks, aren't they?
They are, and a high volume pullback like that is often a necessary digestion phase after such a huge run-up. It lets the stock cool off and process mixed headlines, like the ATM news. For many long-term investors, that correction was seen as an attractive entry point.
And what's the street thinking now? What's the consensus?
Overall sentiment is still highly favorable. I mean, Wall Street is very bullish, with price targets going up to $130 from some of the more optimistic analysts.
And what about institutional ownership?
We're seeing heavy institutional accumulation. They own nearly 22% of the stock, with a lot of large funds starting new positions this year. It shows real conviction in the story.
So what should listeners be looking for over the next few months to see if this thesis is playing out? What are the forward catalysts?
The most critical checkpoint is the next earnings report, probably in late February 2026.
And what needs to be in that report?
Two key financial proof points. First, they have to confirm they met their full year 2025 revenue guidance. Second, and this is crucial, we need to see if that adjusted EBITDA did in fact turn slightly positive by year end. That's the operational inflection point.
And operationally, what milestones are we looking for?
We need continuous updates on new physical capacity coming online. The market needs to see that they're successfully accelerating those ramps. And, a huge catalyst would be announcing a third global scale customer.
Beyond Microsoft and Meta.
Yes, that would dramatically reduce the concentration risk and really confirm their appeal as the leading neocloud provider.
So, to sum it all up,
In sum, Nebius is in the middle of this high-stakes major transformation. It's moving from a speculative hyper-growth promise to becoming a contracted AI infrastructure giant. It's an extremely attractive high-beta opportunity, provided you, the listener, are willing to underwrite the aggressive $5 billion capex and the dilution risk that comes with scaling to that $7 to $9 billion ARR level.
The path toward that ambitious $7 to $9 billion target in 2026 is certainly compelling for a multi-year view, but it's all contingent on their ability to execute this massive build-out without delay. Thank you for joining us for this analysis. Make sure you subscribe, like, and comment below to stay on top of the market with Smart Wealth with Joshua.